with us here on ET Now. We have with us Milind Agarwal, who is Fund Manager, SBI Mutual Fund, to talk to us about banks and some of the updates that have come through. Milind, very good morning. Let me start off by understanding your assessment of the numbers, because at the outset the numbers looked quite strong, but the street's reaction far more muted than what one would have anticipated. Is that how you are penciling in the kind of reaction? Were you penciling in this kind of a reaction? Would you have expected something stronger?
Yeah, hi. Thank you. Hi. Good morning. So over the last couple of days, we've seen provisional updates from banks as well as NBFCs, and within banks, we've seen both private sector banks and PSU banks reporting reasonably good numbers on sequential uptick in credit growth. Now, if you look at RBI's own data on fortnightly basis, the credit indicators were moderately positive till about the beginning of September. But clearly looks like there's been some incremental uptick in credit offtake as we moved towards the end of the quarter. This was also helped by some bit of consumption boost, and there is always a quarter-end phenomena which supports credit growth. But in itself, the numbers are certainly positive than most expectations on a sequential basis. Now, what this does is it also moves or pushes forward the YOY credit growth number from about 9 to 10% to incrementally about 11%. The good thing about this growth is that it looks like it is fairly broad-based across both private sector banks as well as PSU banks. Even some of the NBFCs that have reported the provisional updates, they've seen pretty healthy growth numbers. So directionally, the numbers look to be trending in the right direction. In terms of the stock price moves, on an immediate basis, markets also need time to absorb some of these numbers. And if you look at the narrative for the banking stocks, growth is one aspect, but the other aspect is also in terms of the margins bottoming out and how the asset quality performance is. So the combination of three at least directionally looks positive to us. But we'll wait for the quarterly results to come out and have a firmer view in terms of how margins and asset quality numbers are.
Absolutely. But having said that, were there heartening signs, at least, Milind, when it came to, say, numbers like a Kotak Mahindra Bank, wherein the business traction continues to remain steady?
Yes, certainly across some of the mid to large size private sector banks, whether it is HDFC or Kotak, the mid to large private sector banks, or it is on the PSU bank front, wherein you've seen Bank of Baroda, Indian Bank and PNB. So across these mid to larger banks, we've seen a fairly healthy credit offtake, which suggests that overall at the system level, we are in a very healthy position versus how we were, let's say, a couple of quarters back. So these numbers across banks, at least on the asset side, are fairly healthy.
Okay. Milind, talking about sustainability of some of these numbers, you did mention that the overall industry is growing at sub double digit, at least for the moment. But some of these numbers looking very, very strong. Do you believe that an uptick in terms of growth is on the cards? And we also saw some good traction in certain pockets in deposits. Is that what is really driving the exuberance, if I can call it, on growth?
Certainly. So in terms of the directional pickup, certainly we are more positive than we have been in the last couple of quarters on growth offtake. Now, we need to see the mix of this growth. So when the RBI sectoral deployment data comes out, it will give us better understanding of which subsegments in particular are driving this growth. Because if you look at the large industry segment, the reliance of that segment to help overall industry growth is today much lower than what it was about a decade back. But that still constitutes about 25% of the overall system credit, and that continues to grow at about 5 to 6%. So we need to see the mix of this growth and where it is being driven. Currently, we do believe that within the segments, SME and consumer continue to do well. So that's one area where we think numbers continue to surprise on the positive side.
Okay. Milind, between PSU and private, of course, PSU trades at a discount versus private, and I'll come to NBFCs in a bit, but PSU versus private purely. PSU trades at a discount, but now growth has started to inch up. Profitability, you believe, will hold up, and therefore will our valuations in the PSU pocket looking far better from a risk-reward perspective, I'm asking, and not absolute valuations. But from a risk-reward perspective, is PSU looking better than private in your opinion?
Look, in terms of the entire market or the way the benchmark is constructed, private banks, obviously, given the large free float index weight, they constitute a large part of the index, but PSUs are also fairly sizable there. Now, if you look at the numbers for PSU banks, clearly they've done better on growth versus the expectations. Most of the PSU banks today are growing in line with the system growth or better than the system growth. The other aspect to look at here is on the margin front. So now private sector banks have a larger proportion of their loans which were linked to repo rates. And given that there is a straight pass-through with repo cuts, and we've seen 100 basis points of repo cut, the margin cut for private sector banks has been much sharper. Versus that for PSUs, they have a relatively lower proportion of repo-linked loans. And they also have a slightly higher proportion of MCLR-linked loans. Now, MCLR cuts, while we've seen 100 basis points of repo cuts so far over the last 7 to 8 months, the MCLR cuts have only been of the order of 20 to 30 basis points across most PSU banks. So the margin fall for PSU banks has been far more moderate. And across the banking universe, we believe Q2 for most of the bigger banks would be the bottom on the margin front. More so for PSU banks, especially for PSUs, we do believe the margin decline would be more moderate or lower than what we expect for the private sector banks. And on the asset quality front, we do believe we are still in a benign environment, while there continue to be certain pockets in particular like MFI and credit cards, which are seeing some degree of stress. But on the whole, the system continues to behave quite okay on the asset quality front. So putting these three together, we think PSU earnings and hence the return on equity numbers are quite healthy. And given that on a relative basis, they have been underperforming the broader financial services index, the risk reward there looks reasonably attractive.
When it comes to NBFCs though, do you think it's a given how the quarterly updates from some of them have been, that you've got to restrict yourself to the consumer lending NBFCs? That's where the big alpha generation could happen?
Yeah, so on the NBFC front, if you break it down, we have gold finance companies, you have housing finance, you have commercial vehicle, and then you have consumption-linked NBFCs. Gold continues to see fairly strong tailwinds to an extent also driven by gold price increase. Housing on the industry, at the industry level, we've seen more moderate growth on housing loans, but some of the NBFCs here continue to gain market share, so the growth numbers are fairly healthy there as well. On commercial vehicle, we are still to see an offtake improvement on the commercial vehicle and construction equipment side, and that is essentially a derivative of how the underlying economy is doing. So we believe the price cuts on the commercial vehicles and construction equipments would have to be offset by a proportionate volume increase. But now if we turn to your question, which is more on the consumption side of the NBFCs, there we are more positive than, let's say, some of the vehicle financing NBFCs. And hence we believe, given the offtake in consumption to an extent also aided by the GST cuts and NBFCs as well as banks becoming a lot more comfortable with the underlying credit quality. And we should also remember that beginning of the year, there was also a tax benefit that accrued to the salaried class. So all of these things put together, we believe we are in the early stages of a consumption pickup, and that should essentially benefit the NBFCs that operate in this segment.
Beneficiaries, Milind, would you believe that this consumption push should drive more auto lenders or CVPV kind of lenders? Should the tilt be more towards other consumption? Give us that sense. I know we can't talk names, but give us that sense.
So unfortunately, we don't have any lenders that are listed and cater to the passenger vehicle segment. So what we have is diversified vehicle lenders who cater not just to the personal vehicle, but also to the commercial vehicle and construction equipment. So there, while we do believe PVs are set for a strong rebound in terms of growth rates, and PV financiers would hence benefit, on the commercial vehicle, we'll still watch for data on utilization of the fleet and how the lenders are able to offset the price decline or the price cut by a proportionate volume increase. So while we don't have any passenger vehicle financiers, the CV financiers do have a certain degree of PV exposure, but that in itself is not material in terms of driving their earnings upgrades. That we believe on the NBFC front in terms of consumption uptake can be played better through a consumption financing players.
Okay, great to have you then on the show, Milind. Thanks as always for joining in with your view on the entire financials pack.
Thank you so much.
Okay, let's move on and let's talk about the IPOs. The mega ones which are going to hit D Street today. There's 7 in all, but between Tara Capital and LG Electronics,